Hello viewers, in this video I'll be going over natural gas, ETF ticker symbol UNG. Today we are down 2.4% on the 1 hour chart. We do see we are currently oversold on the 1 hour RSI. However, we do see a possible convergence on the 1 hour MACD, and on the 4 hour chart we are also oversold on the RSI. We are below the 200 moving average, which is a concern, so we may even possibly touch back to this 200 moving average and get repelled back down lower. And on the daily chart, we see a divergence as indicated last week on the daily MACD. And since the market has not closed and we have about 2 hours left in trading, if we close below the 50-day moving average, that will be a concern, and we may head lower. And at the moment we also have the 9-day moving average diverging into the 18-day moving average. So the next possible support that I see, if we do breach this moving average, the 50-day moving average, the next support will be around the price of $18.25. Reason why, we have a price concentration at that level, and it is also coincides from early August back to June 20th. So back there we have these price supports, and as for resistance, we have I would say the next resistance after having a divergence on the 18 and 9-day moving average will be the 9-day moving average, acting as our first resistance if we were to reverse and head up lower or head up higher. And that price movement, if we were to head up higher, will be 7%. And if we were to continue this downside, the price movement is roughly 8.3%. So let's head to the forecast model. On here, I'll go day by day, where natural gas will head to the next coming days. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these forecast models we should focus on? Ideally, the model that is the best match to the current trend. We have the current trend right here, and below is the trend that I believe is the best match, and this trend dates back to April 1st, 2010 to June 28th, 2010. Let me point out why these two charts are similar. So what we have in the beginning, we started off touching the upper Bollinger Band. So let's mark all the instances where it touches the upper Bollinger Band. So we have those two, and then let's mark where it touches the bottom Bollinger Band. We have one right there. And next, let's mark where it proceeded to touch the bottom Bollinger Band as well. And we have those 4 instances, and we start to see a similar pattern shaping on the trend in question as well. So we have a touch on the upper Bollinger Band and another touch, and finally let's mark all the instances where it touches the bottom Bollinger Band. So we have that there, and finally right towards the end it nears the bottom Bollinger Band. So we have about 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the forecast model that we just examined was April 1st to June 28th, 2010. Back then, natural gas was down roughly around 8 or 7.5, fairly close to where I marked on the technical analysis support. And this forecast model is available in the link below, and it will be released when it's finished. And just sign up, submit your email, and you'll be emailed when it'll be finally released. And here's the line graph that I compared it to. So we have the current trend, and overlapping it is the 2010 trend. And thank you for watching. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.